Welcome to the latest episode of the Financial Frontier. I'm your host, Patrick. Really looking forward to today's episode. I'm expecting that you'll get a lot of value from it. There's a lot to cover from a regulatory, tax, and accounting perspective. There's a lot of enforcement action that we're seeing that I'm going to want to cover, some of the news about that, as well as some developments on the regulatory front, and just some things that I want to comment on that I'm seeing at my practice at Camuso CPA that may help you, whether you're a tax professional, financial professional, Web3 CEO, or a digital asset investor. So again, looking forward to it. Let's get into it. We'll start by doing a screen share here. And firstly, I want to point out that we're interviewing Adam Blumberg, who is the co-founder of Interaxis, a CFP that works with a ton of financial professionals, onboarding them from Web 2 into Web 3. And we will be airing this interview on March 18th. We have about 50 attendees scheduled right now, and that's growing every day. And we cover a lot of interesting topics in this conversation. So I definitely encourage you to check that out. And I believe that, there'll be a lot of value in there for you. Additionally, on April 4th, we're going to be hosting a guide where I'm going to just basically go over best practices and some of the things that I've seen at Camuso CPA in tax resolution related to cryptocurrency. Both, what are some of the areas that people are having issues with in their reconciliations, and what are some of the best approaches to actually solving these issues with the IRS and getting into compliance. So this is going to air on April 4th at 10 a.m. This will also be live. Right now we have about 70 attendees, and this is also growing every day. So keep an eye out for this. If you have any compliance issues at all, this video will likely be able to deliver you some valuable suggestions and information. So let's start getting into the news now. First off, we have Biden resurrects 30% crypto mining tax in a new budget proposal. So this proposal we have seen in the past, and as the headline states, in a new budget proposal, they're sort of bringing this back. So U.S. Senator Cynthia Lummis, who is usually pretty favorable to crypto, said that while this shows the government is still bullish on crypto, a 30% tax would destroy the industry's foothold in the country. So basically what they're looking to do is to put a 30% excise tax on anyone that uses electricity to mine crypto. So here, the Treasury wrote, any firm using computing resources, whether owned by a firm or leased from others to mine digital assets, would be subject to an excise tax equal to 30% of the cost of electricity used in the digital asset mining. So what they're basically saying is if you're mining crypto, they're going to look at your electricity cost and they're going to charge you 30% of that in the form of a tax. So if implemented, they would have to report the amount and type of electricity they use. And then they would have to report the value of the electricity that they used if they purchased it internally. So this bill, if this proposal was to be effective, it would be effective for the taxable years starting in 2025, after December 31st, 2024. So if they do implement this, they're going to implement it in 3 phases: a 10% in the first year, 20% in the second year, and 30% in the third year. And they also say that this tax will apply to firms that generate their own electricity used in different forms. Even if they're going to acquire it as power off grid, they have to pay the 30% tax. So this, obviously, no one's happy about this. You can see some comments here. This will place a huge burden on crypto miners. I would expect if this tax got implemented, we may see a lot of them try to leave the US. So, this hasn't been the first time that they've tried to implement this, and in the past they haven't been successful. So we're going to have to just basically wait and see if this proposal does get approved and put into effect. It's going to have a huge impact on Bitcoin miners, and it's also going to really create even a new layer of complexity and tax reporting requirements for them, because they're going to have to track all of their electricity costs now. So, it's going to put an administrative burden, but more importantly, it's going to put a very large tax burden on miners. So next up, we are looking at a headline, and this is basically talking about the IRS's new tax enforcement initiatives. They have a few different targets that you'll see here: millionaires, corporate jets, and crypto. So, the big one I'm focused on is obviously crypto, but they're focused on millionaires, corporate jets, and crypto. So also, the fact that they're focused on millionaires really ties into this. What we're seeing now are a lot of tax notices going out to higher income taxpayers who also have not filed their crypto transactions. We're seeing a lot of notices related to that. So even a lot of these taxes can get combined as well. So this is a result of the Inflation Reduction Act of 2022, where the IRS received substantial funding. Now, as a result, they're expanding their enforcement efforts. So they made this announcement just recently that these are the areas that they're focusing on. So the high income non-filer. Now, this isn't directly related to crypto, but like I said, we're seeing a lot of non-filing related to crypto activity. So that alone is going to draw attention. And there's a lot of tax notices going out to people that are in that position. But then on top of that, if you're high income non-filer with crypto, it's even going to become more of an issue. So the new initiative started with a compliance letters mailed to more than 125,000 individuals who have not refiled their returns since 2017. More than 25,000 of those letters were to taxpayers with incomes above $1 million, and the rest are from 400K to 1 million. So they'll be getting the CP59 notice, and the IRS is estimating about 20,000 to 40,000 letters will be mailed weekly. So this is going to be a big wave of tax notices that are going out. And as a result, there's likely going to be a lot of people looking to file, and a big percentage of them are going to have cryptocurrency activity, because again, that's something I'm seeing every week. People reaching out to my firm and me doing initial consultations with them to discuss their compliance history, their accounting needs, and it's very common to have to go back all the way to 2016, 2017 timeframe, because basically, a lot of times once people started getting into crypto, they stopped filing for various reasons. Sometimes, they just didn't know how to deal with it, or everything was just too unclear to them, or whatever it may be, but it's a very common issue that I'm seeing. The corporate jet initiative, I think, is interesting. It's also announced a highly targeted enforcement effort on the tax treatment of corporate aircraft. So this isn't really my niche, but as I understand, there can be some substantial accelerated tax deductions if you do buy corporate aircrafts, and likely they're going to be, scrutinizing that. So I think the big ones that are going to relate to my practice and likely to your practice or to your company are going to be the focus on high net worth individuals and on cryptocurrency. So in the past, as historical states, we've seen the IRS start to prioritize cryptocurrency, but it really seems to be moving into a new phase now with the IRS. We recently, as I covered on the last episode of the Financial Frontier, we've seen the first tax indictment for someone that's filed fraudulent tax returns related to crypto. Frank Algren III, who's facing 3 to 5 years for each count of returns filed inaccurately. I believe we're talking about 3 to 4 years of returns. So there's definitely a focus already when it comes to crypto tax enforcement, but now this is even going to continue to increase with the IRS. And according to the IRS, when it comes to crypto, based off of the information that they have, the transaction information that they have, there's only a 25% compliance rate, meaning 75% of taxpayers that the IRS believes have cryptocurrency activity have not filed. So with their renewed crypto focus and this focus on high income taxpayers and non-filers, this is going to be one of the areas that we're going to see them target. And like I said, to a degree, we're already seeing this. Sometimes taxpayers will come to us as a result of a tax notice saying they haven't filed. Other times, the market sentiment shift or just some other catalyst makes them realize that now is the time to start filing. So we'll see as these notices go out. I expect that CPA firms with a crypto focus are going to have a big wave of people with tax needs and prior year reporting. So as this article states here on the next article, let me share this one. Tax pros brace for a tidal wave of crypto tax scrutiny from the IRS, what investors need to know. So like I said, across the board, we are expecting a much higher level of scrutiny for the IRS when it comes to cryptocurrency tax enforcement. And there's going to be a lot of letters going out to non-filers. Right now, I believe the IRS's biggest focus is on non-filers just because of the overall compliance rate is so low. Like I said, according to the IRS, it's 25%. So to a large degree, they're going to want to focus on these non-filers, but that doesn't mean that there's not other low-hanging fruit for the IRS. I believe after non-filers, the next biggest target are going to be people that are applying the wrong tax treatment to certain transactions or to their entire portfolio. Because after going after non-filers, I think the next easy target is to find people that are applying the wrong accounting method, applying the wrong tax treatment to certain types of assets, because those types of issues won't necessarily require as intensive of resources from the IRS as if they're going to have to recalculate your whole portfolio. So I believe first they're going to go after non-filers. Then after that, they're going to look for people that are taking incorrect tax positions. And then after that, likely you're going to look into more inaccuracies in the accounting. So digital assets are one of the agency's priority areas. Everyone's been waiting for the tidal wave of enforcement. I agree with that statement. I've been expecting this for some time, and I think people are going to be shocked by the result of this. So there's, as this article is saying, is something I was alluding to, there's also been a rise in digital currency tax investigations from the agency's crime unit, including unreported capital gains, mining, and other income. And that's from a 2023 annual report. So we're seeing the crime unit starting to pick up steam on tax enforcement cases. So here, this individual is alluding to the John Doe audits. So the John Doe audits are how a lot of the raw transaction data from exchanges are collected by the IRS. They're saying that's going to trigger a significant amount of crypto enforcement. And I believe that's the case too, because it all goes back to the fact that most people aren't filing. The IRS, when they get access to these transactions, are going to have that information and are going to send out tax notices and start to enforce compliance, and what we're seeing now. So also, the IRS, as they say here, they've been collecting data with the on the front page of the return saying whether or not you had crypto activity under penalty of perjury. This is going to be more problematic for taxpayers that have been checking that box no and do in fact have activity. And as they're saying here, if you've consistently shown a pattern of deceitfulness and it starts to look like willfulness, that's when the hammer comes down, and that's when the tax enforcement can start to turn criminal and start to come with more serious repercussions, like we're potentially seeing with Frank Algorand III. So, while the IRS has been collecting all this information on taxpayers. They've also been asking taxpayers under penalty of perjury each year to tell them whether or not they had activity. So if these aren't congruent, that's when you're seeing, as stated here, the tax enforcement is likely going to become much more severe. So yeah, crypto is something they're looking to use to close this tax gap of uncollected funds. So the focus, I think, is going to pick up this year and only continue as we move forward, and also as we move into a bull market and we start to see more euphoria and just focus on crypto just from the general public. That also is going to be a catalyst that is just going to lead to more focus from the IRS as well, and from other regulatory agencies. So, a lot of people like to say the IRS doesn't know crypto, they don't focus on crypto. I've always said that's not the case, and I think the IRS has taken even more strides to really have serious assistance and knowledge within their organization related to crypto. And as we see here, the IRS hires former crypto executives to bolster tax regulations. So this was an announcement made on February 27th. The IRS has hired 2 former executives from the crypto industry to strengthen expertise and competence in digital assets as tax season approaches. So for the first person, I'll probably butcher this name. It's Raj Mukherjee, the former global head of tax at Consensus and former executive at Binance U.S. unit, will serve as an advisor to the IRS. Seth Wilt, who previously worked at a crypto tax firm, TaxBit, will also take a similar role. So the IRS Commissioner, Danny Werfel, said that the agency is bringing in experts from the private sector to lead the IRS efforts in building service reporting, compliance, and enforcement programs on digital assets. So, they're pulling in expertise from the private sector to work with the IRS to, build a more comprehensive system for the IRS for tax enforcement. And it says here the agency's financial crime unit will also be investigating a growing number of cases linked to cryptocurrency tax evasion. So they are hiring some of the leading cryptocurrency and tax experts to assist them overall in developing an audit and compliance program. So you can see those are major players in the space with deep industry knowledge, both just at the industry level and also at the tax level. So the IRS is not only building up its internal competencies related to digital assets, but now you see them also tapping the private sector. And this isn't the first I've really covered them tapping the private sector to bring in some of the expertise to assist the IRS with this. We've seen requests for proposals from the IRS months back to different digital asset accounting softwares and subledgers, looking to get proposals for them to assist the IRS in calculations and reconciliation. So this seems like even a further step they're taking along this route of looking to the private sector, bringing in expertise that they don't have, and improving their systems to understand crypto and to enforce it. So briefly, I want to go over this case study that I posted about a client here. Basically, what went on here was this person, this is a pretty common scenario, started in 2018, and they basically were they thought they can just sort of plug and play a software, plug their wallets and have everything be accurate. But of course, that's not the case. You need to leverage good accounting solutions, and there's plenty that are out there, but none of them are going to be plug and play, meaning you're going to just drop in your wallets and exchanges and get a tax report perfectly produced for you that's accurate and sent to an audit. There's constantly going to be reconciliations, data issues, tax considerations that need to be implemented into that accounting system. So basically, this client tried to, use the softwares and Obviously, it did not work out for them. They were having huge discrepancies and inaccuracies. And that's basically the first thing that brought them to us. What we were trying to do was see what we can salvage from their accounting from the prior years. Because of the cumulative nature of cost basis calculations for crypto, you need to start from your earliest transaction and work forward to the latest transaction in order to get an accurate cost basis calculation. So if you calculate any prior year inaccurately, it can cause inaccuracies for the future years. So, one of our first steps to a client like this is trying to see how far back do we have to go, or how far back exactly are their accounting records inaccurate. In this client's case, most of it was inaccurate, but we were trying to salvage some of the earlier years with less volume of activity. But then we run into another common issue with this client, and that was that the particular software that they were using was providing them the reporting we were really looking for. And what we're looking for in this case, when we're looking to roll over the ending cost basis from one system to another, is the detailed ending cost basis report at the tax lot level. This will allow us to take your ending holdings from any given tax period at the detailed level that we need for audit trail purposes and roll it over into a new system. And what this can avoid is you having to rework prior reconciliations that you've done. Now, in this client's case, they didn't have access to that. They only had access to a summary report. The summary report is better than nothing, but for the purposes of establishing an audit trail and a flow of funds, it's not sufficient. So, what did we have to do with this client? We had to basically set up a new accounting system for them from scratch that ensured accuracy, due diligence on their actual to calculated ending cost basis, as well as other due diligence checks. And then one thing that we always make sure that we do at Camuso CPA is make sure that you own the data. You have your consolidated transaction history, full audit trail and tax reporting for gain, loss, income, spending, and of course your detailed ending cost basis report at the tax lot level. So that's what we had to do with this client. And this is something that we basically do on a weekly or daily basis at Camuso CPA. This is a very, very common issue that we're solving. So then lastly here, if you go to camusocpa.com, I just want to draw your attention to one of our latest blogs, Web3 Tax Implications for DAOs, Ensuring Transparency and Compliance in Decentralized Organizations. So this is a huge topic right now. It's one of the emerging tax issues, I would say, in Web3. There are a few. This is definitely one of them. One of the main issues that we cover in this report related to DAOs are the entity structure considerations and the tax implications associated with this. That's one of the big challenges for DAOs right now, is ensuring that number one, establish an entity structure and establish the correct entity structure that's going to enable them to be compliant for tax purposes. In this article, we'll also go over some of the challenges to that related to just DAOs in general, the industry, and the desire for decentralization, and how there basically has to be a balance that's found between the two. So again, you can find this article at camusocpa.com, and it goes over good details related to this and some of the top issues that DAOs are facing. So I encourage you guys to check that out. So those were most of the topics that I wanted to go over today, and I hope you were able to gain some value from those. If you're looking for more information that I wasn't able to fit into today's episode, I encourage you to sign up for the Digital Asset Digest. That's our newsletter where we'll cover a lot of these topics along with many other topics I just can't really get to on these episodes. So you can sign up for that newsletter either at our website at camusocpa.com, or you can sign up for the newsletter right on LinkedIn by going to my profile and signing up for the newsletter in the newsletter section. So again, there's a lot of moving pieces related to tax enforcement, some emerging tax considerations, and we're trying to stay on top of it all here on the Financial Frontier and the Digital Asset Digest. Until next time, I'm Patrick Camuso signing off.